Investors are keeping an eye on Japan, where the central bank's governor issued a few comments on Thursday that may mean the country is set to exit from the ultra-low interest rates it has had for decades now. Meanwhile, markets are pricing in rate cuts next year for the Fed, as well as the European Central Bank and the Bank of England. Let's bring in Yahoo Finance's Blikre, who is tracking the impact of these rate bets. Hey, Jared.
Hi there. We are tracking this in the Forex market, that's foreign exchange, where we see everything here is the Japanese yen crossed with other pairs across the world. We have the number one gainer here, actually the gainer versus a Mexican peso. That's up nearly 3%. Then we have the Swiss franc. Then we have the Argentine peso. We have the US dollar here. The Japanese yen doesn't move this quick. In fact, most foreign currency pairs do not move this much in one day. This is very upsetting for a lot of traders here. Let's take a look at the year to date. Now, first, I'm presenting this pair in inverse order. I just wanted to get a good comp where we can show the Japanese yen versus everything here. But the yen has been weakening all year long. And if you take a look at a 3-year chart, it's actually been weakening. It's lost a quarter of its value to the US dollar. And let's examine exactly why that is. Now, here I have global interest rates. This is the Fed funds, the ECB deposit rate, the Japan policy rate. So these are the short-term interest rates of these three banks going back to the global financial crisis. And you can see most of the policy rates after the global financial crisis were around zero. And then we had Japan experimented with negative rates. And that's where they still are. And the ECB experimented with them too. However, the ECB lifted off, so did the Fed. And then with these higher interest rates in the United States, that encourages all these capital flows into the US dollar from the yen in order to be able to take advantage of it. So that's why the yen was weakening. Now that it looks like the Bank of Japan is going to be strengthening next year, and perhaps even this year, traders are going a little bit, I would say they're trying to shuffle their books to align with reality here. These are global yield curves. This is Japan, US, and Euro. And the one thing about Japan is it's still upwardly sloping. This is exactly what you expect in a yield curve where longer dated tenors command a higher interest rate. But that's only because the Bank of Japan has been artificially keeping rates very, very low on the short end of the curve. So the big question for traders is what happens when you get that liftoff? Is it going to be an orderly unwind or a disorderly one? And I would share that it's probably becoming disorderly. And that's what we're seeing, because this is the odds of a rate hike for the Bank of Japan at their December meeting in about 2 weeks here. Those have been shooting up. Now, it was thought only a few days ago that this was not a live meeting. This was not a meeting at which the Bank of Japan would have to raise rates. However, bond vigilantes are telling them another story, and we're seeing this huge move in the currency market today as a result. We don't know exactly when the Bank of Japan is going to have to normalize, but this is probably going to be one of the bigger stories of 2024, especially in the early goings here. Interest rates affect everything else. If Japan raises their interest rate, I want to show you what happens in the US. The US rates actually lower because global funds are competing for demand of the highest interest rate all around the world. So today, as a result of all these moves in the Japanese yen, we're actually seeing an increase of about 3 basis points in the 10-year T-note yield. If Japan explicitly raises their rates, that's going to shoot higher. And we know that higher rates in the US present problems for stocks. So all of this is engaged in a giant feedback loop. We've had ultra-low rates in Japan for a long time, and concerns for traders are how orderly or disorderly is going to be policy normalization. A question for the new year, but maybe now in December.